This is our second class on share capital. At the end of the previous class, we said that we are going to deal with the redemption of preference shares in the next class. That is where we are now. This is a good time just to tell you that there are two versions of these slides for each of these classes available. The first version is with audio, where you will hear our voices, my voice, and you should do that first for each of those classes. So that will guide you through the slideshows, almost like you are watching a movie. Then there will be a second version which has no sound, no audio, which you can then look at in your own time. You can page up or page down, you can go to a previous slide, you can go to the next slide, so you can cover that in your own time. It is important though that you look at the one that has the audio first, so that it guides you through the process, and then thereafter you look at the one that you can take your time with. So, redemption of preference shares. So what is a redeemable preference share? You will remember from our first class, we said that when it comes to the types of preference shares, they can be redeemable or non-redeemable, they can be participating or non-participating, they can be cumulative or non-cumulative. So this is a type of preference share called a redeemable preference share. Why is it called a redeemable preference shares? Because the company that issues them at the issue date, they already make an arrangement with the shareholders that they will redeem it at a later stage. What does it mean to redeem it? It means that the company withdraws the shares from the market, or they buy it back, and at the same time they return or refund the invested money to those shareholders. As we've mentioned in the previous class, apart from the capital which will be paid back, there might also be at the issue date be an arrangement that an extra amount, an additional amount, could be paid back to the preference shareholders at the date of the redemption. This extra amount is then referred to as a premium at redemption of preference shares. The issue of redeemable preference shares is a common source of funding for companies and is also frequently resorted to by the banking sector to raise capital. So it is a means for the company to raise money when they need money. For instance, when they want to expand the business, they want to invest more in their non-current assets, or they might want to take over the business of another company, a merger or a takeover. So this is being used because it is less costly than a loan or a loan instrument such as bonds or debentures. Clearly, if the company needs to take out a loan, there will be an interest rate set by the financing organization or the financing institution that grants them the loan. But in the case of redeemable preference shares, the company can set their coupon rate or dividend rate, which will then normally be less than the market-related interest rate that they could get. So therefore, it's a cheaper way of obtaining finance. Redeemable preference shares also provide a source of tax-free dividends for investors. We will talk in our second topic for this term, when we talk about taxation, we will look at dividends tax. And we will see that in the case of dividends tax, dividends are taxed at a much lower rate than, for instance, the ordinary income tax for a company or an individual for that matter. As we've said in the previous class, when will preference shares be seen as a liability and when will it be seen as equity? It will be seen as a liability if the redemption of the shares is compulsory already at the date when the shares were issued. So on the issue date, they've already predetermined that there is going to be a specific date when this redemption is going to take place, or the redemption may take place when a certain event occurs, or when the shareholders decide on doing so. So it is not at the option of the company. The company cannot control this. And also when the redemption of shares is at the discretion of the preference holders, as we've just mentioned. The preference shares will be regarded as equity if the future redemption is at the discretion of the company. In other words, when those shares were issued, the company clearly made it stated that they have the full power to decide whether or not to redeem the shares. Why it is then regarded as equity and not a liability? Well, there is no present obligation. It is possible that the company may never decide to actually redeem the shares. So there can only be a present obligation, which then means it's a liability if the company actually owes the money and they have no discretion to delay or defer or even postpone forever the redemption of the shares. At redemption, the capital and cash reserves are reduced. As we've mentioned earlier, the money that the investors, the shareholders have invested in the company will be returned to them, and consequently both the remaining shareholders and creditors are at risk that there might not be sufficient cash resources available after this redemption has taken place to then actually pay the ordinary shareholders or your normal creditors. Therefore, there are certain requirements in the new Companies Act, in the 2008 Companies Act, that prevents a company from eroding or diluting their cash resources to such an extent that they might not be able to pay their creditors or to pay their workers at the end of the month, their salaries and wages. Those two provisions we find in sections 46 and section 48 of the Companies Act. First of all, section 46 requires that when any distribution is going to be made to shareholders, whether this distribution is in the form of dividends or whether it's in the form of an ordinary share buyback, or whether it's in the form of a redemption of preference shares, which is the case we are talking about now, it cannot be done unless that distribution was authorized by the Board of Directors. Section 46 in fact goes further and says that it must be minuted in the Board of Directors meeting. It must be minuted that that has been discussed and the fact that it has been authorized. Section 48 deals with the solvency and liquidity tests. You'll remember from our previous class we said that we will discuss it in this class, so here we are. Section 48 requires that the company satisfies the solvency and liquidity tests immediately after completing the proposed redemption or any other distribution. So what is meant by solvency? It means the company is not insolvent, and that means that the company is not bankrupt or technically insolvent. When a company is technically insolvent, it means the company's assets does not exceed the liabilities, or if you want to put it the other way around, its liabilities exceed its assets. Then the company is insolvent. So clearly the company cannot be insolvent after a redemption or any other distribution. Liquidity means in the short term, can the company service their creditors? Can they pay those creditors that need to be paid at the end of the month? Can they do that? Also, can they pay their day-to-day expenses? Can they pay the salaries and the wages at the end of the month? Can they pay their telephone bill and their water and electricity? Right? So only if the company is going to remain solvent and liquid after the redemption or any other distribution has taken place, only then can it be done in terms of the 2008 Companies Act. What type of redeemable preference shares are we covering in financial accounting 2? We have mentioned that in our first class as well. We are not going to be looking at the situation where the preference shares are seen as a liability. We are only going to look at the scenario where it is seen as equity. So that means the redemption of the shares will take place or can take place at the discretion of the company. The company has got full control over it. And as we've mentioned a few minutes ago, the company may eventually decide never to redeem it. Right, so the company is in full control of that. Now, again, when it comes to the Companies Act, this is quite important to understand that the Companies Act has got all sorts of provisions to protect the shareholders and creditors of the company so that the company doesn't go and bankrupt itself or exhaust its financial resources to such an extent that they cannot pay their expenses or their suppliers. So therefore, the Companies Act requires that if a redemption is going to take place, then the company must either have the cash available to do the redemption, right? So to return the money to the shareholders, possibly paying the cumulative preference shareholders their outstanding dividend, perhaps also a premium on the redemption. So the company must either have the cash available, or if they do not have the cash available, then they must have a financing plan in place on how they are going to pay the shareholders, right? So they must then alternatively have a financing plan in place. So how are they going to obtain the money in order to redeem those preference shares? Now, the company can basically use any kind of financing. Here we are mentioning a few possibilities. They can issue new shares, new ordinary shares, or preference shares. Normally, they won't redeem preference shares and then issue preference shares again. So it'll normally be if they want to get rid of those preference shareholders and they want to redeem those shares, they might issue ordinary shares to fund it. Or they can issue debentures. Debentures, those are loan instrument as opposed to equity instruments. They can raise a loan. In other words, they can approach a financing institution such as a bank to acquire a loan, or they can even use a bank overdraft. So the possibilities are not limited by the Companies Act, as long as they have a way, they have a plan how to obtain the money so that they can redeem the preference shares and still remain liquid and solvent at the end of that process. So if they are going to do financing, if they have to raise finance in order to effect this redemption, they will receive money from the various financial institutions. So let's say they have used all three of those methods to raise money, then clearly when the money is deposited into the bank account, we need to debit our bank account. If we have issued ordinary shares in order to help finance this redemption, we are going to credit the ordinary share capital accounts because we are now issuing ordinary shares. If we are going to issue debentures to partly finance this redemption, debentures being a loan instrument, then we have to credit the debentures account. In this case, the debentures carry an interest rate. In this case, remember, it's an interest rate because it's a loan instrument. It's not a dividend or a coupon rate. Even though in the case of debentures, they also call it a coupon rate, but it's not a dividend rate, if you know what I'm saying. Right, so the debentures carry an interest rate of 8%. So we're going to credit 8% debentures. And if we have taken out a loan from XYZ Bank, then we're going to credit that account, loan XYZ Bank. What must be financed? Now, there is a good question for you. It all depends what the company can afford to pay out of their own resources. If they can do the whole redemption from their own money, then obviously they don't need any financing. But if they need financing, if they haven't got sufficient cash available already to prevent them becoming insolvent or illiquid at the end of the process, then we have to see what must be funded. Are they only going to return the share capital, in other words with no premium, no dividends outstanding, or are they going to do the preference share redemption at a premium, so then you have to provide for the capital, the share capital that you are going to be returning, as well as that little extra amount which we call the premium at redemption. There could be other expenses involved. For instance, there could be share issue expenses involved if you are going to do an ordinary share issue to help fund this. Then if you haven't got the money available to pay the share issue expenses, you might also have to include this in your financing plan. And then also the preference dividends. If the preference dividends are not up to date and you haven't got sufficient funds available to pay it out of the company's own resources, then clearly you will have to make this part of your financing plan. When it comes to a question, you must please read very carefully. What is going to be paid back? Is it going to be only the capital? Is it going to be the capital and a premium? Or is it going to be the capital and the premium and outstanding preference dividends? Especially when it comes to cumulative preference dividends, which we spoke about in our first class. You cannot go and redeem those preference shares unless your cumulative preference dividends are up to date. And then also, as we've spoken in the previous slide, how are we then going to finance? Right, so what happens physically when we are going to do a redemption? We are going to withdraw those shares from the market, right? So those shareholders will not be the owners of the shares anymore. And at the same time, we are going to refund their money to them. So the money that they've invested in these shares will be returned to them. So what would a typical journal entry look like? Here we have it in front of us. First of all, we know that those shares are going to be withdrawn from the market. So clearly we've got to get rid of the balance that is currently in our preference share capital account. And that account being equity, it means it has a credit balance. So to get rid of that balance or a part of that balance, remember the redemption is not necessarily always of all the shares. It could be half the shares. Then you only need to get rid of half the amount in that account. Or if they are going to redeem, let's say 25%, 1/4 of the shares, then you only need to get rid of 1/4 of the balance on that preference share capital account. In any case, to get rid of a balance when it has a credit balance, it means you have to go and debit that account, right? And then we also have to raise a liability towards the preference shareholders. That is the credit at the bottom of that journal entry that you can see in front of you. So we're going to credit preference shareholders, the liability, and then we've also got to decide what do we owe them in total. If we are only going to return the original investment to them, the amount, in other words, that is currently in our share capital account or portion of it, then that will be the same amount that we owe to the preference shareholders. However, if we are going to refund them a little bit more than they originally paid for the shares, which means we are going to pay them a premium at redemption of preference shares, then we cannot take that out of our preference share capital account because it's not in the preference share capital account in the first place, but it is an amount that we then are going to owe to the preference shareholders. If our preference dividends are not up to date, then we have to clearly declare the preference dividend. So the preference dividend that is going to be declared will also be debited. As you know, it is a distribution of our retained earnings, and that will then also be included in the amount that we owe to the preference shareholders. So if we're going to return the money to the shareholders, we redeem the shares, there's a premium at redemption, there's also a preference dividend, then all three of them add up to the amount that we owe to the preference shareholders that we are going to credit that preference shareholders account with. The premium at redemption of preference shares, that's the additional payment, the additional amount that we are going to refund or not refund, that we are going to pay them, additional to what those shareholders originally paid when they acquired the shares. That premium at redemption of preference shares will not be written off to your profit or loss account. it has to be written off in terms of the Companies Act directly against your retained income or retained earnings account, which means that it is not going to be an expense that is part of the profit or loss statement or part of the statement of comprehensive income. It is an item that is going to be shown as a reduction of the retained earnings in your statement of changes in equity. So in our statement of changes in equity, which we see an extract of on this slide, the premium at redemption will be disclosed in the same line, where we show the preference share capital, the capital portion that is returned to those shareholders. There we can clearly see with that arrow, the premium at redemption reduces, it's a negative, it reduces our retained earnings. So what we have there is under the preference share capital, that minus that amount in brackets is the actual capital that we are returning to the preference shareholders. In other words, that equals the amount that we are returning that they have originally paid when they acquired the shares or they took up the shares when we issued it. And then the premium at redemption, that extra amount that we are returning to, or not returning, excuse me, that we are paying to them, will be shown under our retained earnings column, right? And the total will simply be the one plus the other. So let's look at an example. At this stage, we are ignoring dividends tax. As I've mentioned a few minutes ago, we are going to be looking at taxation matters when it comes to company dividends tax, capital gains tax, income tax. That is our next topic for this term. In this example or exercise, we have X Limited, the name of the company, has an authorized 12% preference share capital of 150 shares of no par value. Just remember the 12% preference share capital, that 12% refers to the dividend rate or coupon rate. The preference shares can be redeemed at the option of the company anytime as from the 31st of December 2019. Why do we say at the option of the company? That indicates that we are seeing it as equity, right? Not as a liability, but as equity. If it was at the option of the shareholders, or if there was a specific date when the redemption is going to take place, or if it has to take place when a certain event occurs. I know I'm repeating what I've said earlier, but just to emphasize it again, then it would have been seen as a financial liability under our non-current liabilities. So the following balances, amongst others, appeared in the books of this company X Limited on the 31st of December 2020. The 12% preference share capital had a value of 500,000 rands. We can see there that 100,000 shares are in issue, so the average issue price is clearly 5 rands per share. We've got retained earnings of 400,000 rands, and we've got money in our bank of 15,000. We continue with the example. On the 1st of December, the Board of Directors of X Limited passed a resolution in terms of which the preference shares are to be redeemed on the 31st of December 2020. So in other words, in 30 days time, at the end of the month, at a premium of 15 cents per share. Or they could also have said a premium of 3%. Remember, it's not always 15 cents, it's not always 3%. Those are just the amounts and percentages for this particular example. Then they say the redemption, excluding the preference dividend payable, is to be financed as follows. Now, there are a few things that we have to consider here. First of all, clearly they say it has to be financed, right? So it means the company does not already have sufficient funds to do the redemption and still remain liquid and solvent after the event, right? So they do need financing. The second thing that we must clearly see here is that they say the financing plan excludes the preference dividends. So that means the company has got sufficient funds, sufficient money available to actually bring the preference dividends up to date. So they are not financing the preference dividend, they're only financing the rest of this redemption, right? Okay, clearly that means the capital that needs to be returned to the shareholders, as well as the premium that we are going to add to the capital when we pay it to the shareholders. So how are we going to finance it? First of all, the company is going to obtain a loan from Sharky Loans Limited for 300,000 rands, and they are also going to approach their bank for a bank overdraft for the outstanding balance from the company, from the company's banker. Okay, so what is required of us? 4 things. First of all, to calculate the amount payable to preference shares, excluding the preference dividend. Secondly, the journal entries, including bank account entries, to conclude the redemption. Thirdly, we must prepare a statement of changes in equity for the year ended 31st of December 2020. And then in the 4th place, we need to prepare the note to the financial statements for the year ended 31st of December 2020 for preference share capital. You remember towards the end of our previous class, we said for every class and for every type of share capital, you will have to have a share capital note. So you already know what it looks like. So we're just going to do another one for preference share capital. So here we have the solution. First of all, the calculation. The amount payable to preference shareholders, first of all, what do we need to do? We have to refund them the capital that they have initially introduced into the company when they took up the preference shares. So we've got to return that to them. In this case, we are going to redeem all of the shares. Remember, it doesn't necessarily mean we always have to redeem all of the shares. Make sure in real life what is minuted in the directors' meetings minutes, or in the case of a question, make sure that what portion or how many shares, is it all of the shares, half of the shares, a quarter of the shares, a certain number of shares that are going to be redeemed, and obviously only the capital for those shares that are going to be redeemed that we need to cancel from the share capital, the preference share capital account, and return that to the shareholders. Then besides the initial capital that was introduced when they took up the shares, we are going to pay them that little bit extra, the premium at redemption of preference shares. Now we can either look at the cents or rands per share, or we can look at the percentage. But if we are going to look at the cents or rands per share, it means the important thing is the number of shares. If we are going to use the percentage, then it is the value of the shares that's the important one. So either way we will get the same answer. So if we use the 15 cents per share multiplied by 100,000 shares, the number of shares, that will give us a premium of 15,000 rands. If we look at the value of the shares and the percentage, 3% of 500,000 rands also gives us 15,000 rands. That means the amount that we are going to be paying to the shareholders besides the dividend, which we've already said we can finance from our own cash resources, will be 515,000 rands. So what will the journal entry look like? Well, as we've said, those shares are going to be withdrawn from the market, right? So they are no longer going to be in issue. So it means we have to cancel or take out the balance currently on that account. If all the shares are going to be redeemed, we're going to totally cancel the balance on that account. If half the shares, for instance, are going to be redeemed, we're going to take out half of the balance on that account. Anyway, as we've said previously, when we looked at a typical entry, the preference share capital, 12% preference share capital, that is seen as equity as discussed. Therefore, it has a credit balance. So now if we have to get rid of that credit balance or part of that credit balance, if we want to lower that, it means we now have to go and debit that account with the amount that we are going to return to the shareholders. We have to debit premium at redemption of preference shares with that 15,000 rands that we've just calculated, that is the additional amount that we're going to pay to the shareholders over and above what we are returning on their original investment. And then we have to raise the liability towards the shareholders. So we are going to credit the account called preference shareholders with the total amount that we owe to the creditors, 515,000 rands. We continue with the journal entry. As we've mentioned, the dividend is not going to be part of our financing plan because the company has sufficient funds to pay that, but the dividend must still be declared and that declaration of the dividend must still be recorded. So we are going to debit the preference dividend, which is 60,000 rands, and we are going to credit the preference shareholders. In other words, we are recording the distribution in our debit entry, and we are going to raise the liability in our credit entry. Because we have the funds available, we can pay the shareholders already. So once we make the payment of the dividend of 60,000, as you know, when we make a payment, money leaves our bank account, so we are going to credit the bank account. And then after we've made the payment, we no longer owe that money to the shareholders, so we are going to debit preference shareholders, so we are going to reduce that liability. Now when it comes to the actual redemption, we cannot pay the shareholders if we do not have the money to pay the shareholders, so we have to get the funding first. So here we have the financing entry. When we take out that loan from Sharky Bank, it means we are receiving money in our current account, so we are going to debit the bank account, and we are going to raise a liability towards Sharky Limited. So we're crediting the account loan Sharky Limited. Once we have the money available to refund to the shareholders, then we can pay them. So we'll see in our final entry there, we make the payment, so we are crediting our bank account, money leaves our bank account, and then we no longer owe the shareholders that money, so we are going to debit the preference shareholders, which means that that liability has been settled. In the previous slide, we saw that we credited preference shareholders by 515,000 rands, and here in the first journal entry, we credited them again with 60,000 rands. So if we made one payment at the end of the redemption process that includes the dividends, then we would not have had that second entry, preference shareholders debit 60,000 and bank credit 60,000. But then the last entry would have changed to preference shareholders debit 575,000 rands to clear the total liability, and then we would have credited the bank account with 575,000 rands as well. So we could have combined the second entry on this slide with the fourth entry on this slide. How will that be disclosed in our statement of changes in equity? First of all, under our preference share capital, we know that the amount of the share capital that we are returning to our shareholders is 500,000 rands in this example. So it is going to be a reduction, a minus an amount in brackets under our preference share capital column. And we'll see in that very same line under retained earnings, we are going to have a minus, or in brackets, 15,000 rands. That represents the premium on redemption. Please bear in mind that that is all in one line. So we're not going to show the return of the capital and the payment of the premium in separate lines. It is in one line. The preference dividend must clearly also be disclosed as a distribution. So as you can see under retained earnings, the preference dividend of 60,000 rands is also a negative or a minus indicated in brackets under our retained earnings column. The preference share capital note that is required As we've mentioned before, you must bear in mind the share capital note deals with the number of shares, not the value of the shares. There you can see that balloon, that rectangular balloon. It indicates with an arrow that the heading of that column is number, not rands, not dollars, not euro, not pounds, not yen. It is number, so it indicates the number of shares. In this note, like we did with the ordinary share capital note, first of all we have to disclose our authorized shares. How many shares are we allowed to issue in terms of our memorandum of incorporation? This being the preference share capital note, it only deals with this particular type and class of shares. So what shares are these? 12% preference shares, and as we've mentioned before, it is important that we state of no par value. That is a requirement of IAS 1, where it states that if the shares do have a par value, the par value must be disclosed, and if it has no par value, the fact that it has no par value must also be disclosed, right? So we are allowed to issue a total of 150,000 shares. Then the actual issued shares or outstanding shares, the balance at the beginning of the year, as we saw in the question, was 100,000 shares. Remember, this is the number. The value was 500,000, but the number of shares 100,000 rands. How many shares did we redeem during the year? In this case, we redeemed all of the shares, so that will be a negative 100,000. And again, remember, when we are drawing up our financial statements, negatives are shown in brackets, not with a minus sign in front of it. So that means in this particular example, the balance of the number of shares outstanding at the end of the year will be 0. If, for instance, they had only redeemed half of the shares, then the outstanding number of shares at the beginning of the year would have been 100,000 rands. Then the shares redeemed during the year would have been 50,000 rands negative, which means that the balance outstanding at the end of the year would in that case have been 50,000 shares. A few comments on that first example. In that example, the company had sufficient funds available to pay the preference dividends, so that was not included in the financing plan. In other questions, the company may possibly not have sufficient funds to also bring the preference dividend up to date. In that case, it must be part of your financing plan. Always make sure when you are reading a question, whether it is the capital only that is going to be financed, whether it's the capital plus the premium at redemption that is going to be financed, whether it's going to be the capital plus the premium plus the preference dividend that's going to be financed, because then it has to be included in the financing plan, and possibly there could be other related expenses such as share issue expenses if you are going to finance the redemption of preference shares by means of the issue of ordinary shares, and the company does not have sufficient funds to pay that, which is probably very unlikely. We have mentioned earlier, if the premium is stated as rands or any currency per share, then the number of shares is the important one. If it is expressed as a percentage, then the value of the shares is the important one. In this question, the redemption was partially financed by a bank overdraft, as that is simply an arrangement with the company's banker to provide them an overdraft. There is no journal entry for that. We can also calculate what will be the overdraft balance after this whole process of bringing the dividends up to date and then redeeming the preference shares will be. Well, we saw in the question that the opening balance was 15,000 rands. So let's see, how many times did we debit the bank account in our journal entries? We debited it once by 300,000 rands, right? So that gives us a balance of 315,000 rands. And then how many times did we credit the bank account? We credited it twice. Once with a payment of the dividend of 60,000 rands, and then also with a payment to the shareholders for the redemption, 515,000 rands. So a total of 575,000 rands was paid to the preference shareholders. So if we take that 15,000 plus 300,000 less 60,000 less 515,000, that means we have got a negative balance of 260,000 rands after this redemption has taken place. So that means we've got a bank overdraft of 260,000 rands. Our example 2 is the same as example 1, except that the financing is done a little bit differently. So let us see what happens here. We still have the same situation where 500,000 rands is going to be returned to the shareholders of the original investment. We're still going to pay them a premium of 15,000 rands. But the financing will be a little bit different. The redemption, again, excluding the preference dividend payable, in other words, the company does have sufficient funds to pay the dividend, is to be financed as follows. They are going to issue 1,000 12% debentures of 250 rands each. Now, as we have mentioned earlier, a debenture is a loan instrument. So it's like a big loan that is cut up into smaller pieces. In this case, they are issuing how many debentures? 1,000 debentures. What is the issue price of the debentures? 250 rands each. So the total money that we will receive by issuing the debentures will be 250,000 rands. And that 12% refers to the interest rate that we are going to be paying on the debentures. In other words, what we will pay to those debenture holders. And then if that is not sufficient money to cover the redemption, then we are also going to issue ordinary shares, as many shares as is necessary, and we can issue them at an issue price of 20 rands each. So we are going to redeem the preference shares, but we are going to fund it or finance it by issuing, first of all, loan instruments, debentures, but also equity instruments, ordinary shares, to have the money to obtain the money to repay the preference shareholders. What is required of us? First of all, calculate the amount and the number of ordinary shares that will be issued, the journal entries, including the bank account entries for the redemption, and then we again have to prepare the statement of changes in equity for the year ended the 31st of December 2020. Here we can see how much do we need to pay to the shareholders, excluding the dividend. Remember, we said we have sufficient money to pay the dividend. We have to pay them 515,000 rands. So how much money are we going to obtain by issuing debentures? We are going to issue 1,000 debentures at 250 rands each. So that will provide us with 250,000 rands extra in our bank account. So how much are we still short? We are still short 265,000 rands. And as we've seen, they are going to finance that 265,000 rands by issuing ordinary shares. Right. So we have to issue ordinary shares to the value of 265,000 rands. We are going to be able to issue those shares at 20 rands each. So just to answer the question, how many shares are we going to issue? The value is 265,000. We are issuing them at 20 rands each. So we take 265,000, divide by 20. That means we are going to be issuing 13,250 shares. What will the journal entry look like? It's going to be similar to the previous one, except for the financing. So again, The very first step is to cancel the share capital. Remember, we are withdrawing those shares from the market. They are no longer going to be in issue. So the credit balance on the preference share capital, or a portion of it, needs to be cancelled. So we are going to debit that account, in this case with 500,000 rands. We have to provide for the extra amount that we are going to be paying over and above what the shareholders paid for those shares, 15,000. And again, we have to raise the liability towards our preference shareholders, the total of. We said that our company has sufficient funds available to cover the preference dividend, but the preference dividend must still be declared. So we are going to debit the preference dividend account, which indicates the distribution of our retained earnings, and we are going to raise the liability towards our shareholders. If the money is going to be paid before the end of the financial year, then we are going to, or any time it is going to be paid for that matter, we are going to credit our bank account with its 60,000 rands, and we're going to relieve ourselves of the liability towards the preference shareholders. We are going to debit preference shareholders. Why I just mentioned that if it is going to be paid before or on the end of the financial year, it means that at the end of the financial year there is no further liability towards the shareholders. But if that payment, let's say, only took place during January, so if the amount was still owing to the shareholders at the end of December, the end of our financial year, that preference shareholders liability would be disclosed under our current liabilities in our statement of financial position. So now we have to obtain the financing and record that. What is the value of the debentures that we have issued? Remember, it's a liability, so we are going to credit the 12% debentures with 250,000 rands. We have issued a further 13,000 ordinary shares to partially finance this. The value of that ordinary shares that we have issued is 265,000 rand, so we've got to credit ordinary share capital with 265,000 rands. So that provides us with the 515,000 rands that has now been deposited into our bank account, so we're going to debit the bank account with 515,000 rands. And then once we have the money, we can pay the money to the preference shareholders. You cannot pay them unless you have the money, so you obviously have to get the money first. Once we have the money available, we are going to do the payment to the preference shareholders, which means we're going to credit our bank account with the amount that we still owe them, and we're going to debit the preference shareholders liability, so that will then come down to a zero balance, indicating that we no longer owe them any money. As we said in example 1, you could have combined the second journal entry on this slide with the fourth entry. So if you just made one payment to each shareholder, that includes the capital that you pay back, as well as the premium, as well as the dividend, then you would have debited the preference shareholders with 575,000 rands, because that is the total balance outstanding towards them, or the total balance owing to them, and then you would have credited your bank account with 575,000. Right. Remember, you cannot do that twice. You either have to have the first entry on this slide and the last entry on this slide, but when you combine them, if you debit preference shareholders with 575,000 rands and you credit bank with 575,000, then you cannot also have that first entry, right? Because then that will mean you are paying them the dividend twice. In our statement of changes in equity, how is this going to be disclosed? First of all, the redemption, just like we had in example 1, 500,000 rands of the value of the shares will be returned to our preference shareholders, so we will have a deduction, a negative, a minus in brackets in our preference share capital column. In that same line, under the retained earnings column, we are going to indicate the premium on redemption, and then in the totals column, obviously we just add the two accounts together. But now we must remember in this particular instance, we financed this redemption by issuing debentures as well as ordinary shares. Now, as we have mentioned, debentures are not equity, right? They're not shares. Debentures are loan instruments, and this statement is called a statement of changes in equity, not a statement of changes in liabilities, for instance, right? So clearly the debentures will not be indicated in your statement of changes in equity, but the financing by issuing ordinary shares, which is equity, will be indicated here. So we also have that line item there that is indicated in green, ordinary share capital, which increases by the value of the shares, 265,000 rands. Here we have example 3. It is also the same as the previous two examples. The big difference here is that the company feels they do not have sufficient funds to pay the preference dividends from its own resources. They also have to include the preference dividends in their financing plan. So if we use the same details as in the previous two exercises, we know that it is 500,000 rands worth of capital that we have to return to the shareholders. We are paying them that extra little bit that we promised them when we issued the shares to sweeten the deal of 15,000 rands, but now the preference dividends must also be financed. So in this case, it must be part of our financing plan. So we add the 60,000 rands of the dividends, which then means that the total amount that we owe to the shareholders, and in this case we certainly are going to pay it back in one payment to each and every single shareholder, whether it's an individual or an institutional shareholder, doesn't matter, they're going to get one payment. So the total amount that we are going to owe to them at this stage is 575,000 rands. By the way, I'm not sure whether we've spoken about this before. If we haven't, let's maybe talk about it now. How do we calculate the preference dividend of 60,000 rands? We did see, if you remember, that the coupon rate or dividend rate is 12%, right? That is why it's called 12% preference share capital. And the value of the preference shares is 500,000 rand. So if we apply the 12% dividend or coupon rate to the 500,000 value of the shares, that is how we get the 60,000 rands. That is the dividends, assuming that no dividend had been declared or paid during the course of this year. And if it's cumulative preference dividends, then it also means that all the previous year, the years before this year, those dividends had already been paid. So what is required? We've got to calculate the amount and the number of ordinary shares that will be issued. Well, in this case, we see that we have to finance 575,000. In the previous example, we were able to pay the 60,000 rands dividends from our own bank resources or cash resources, but now it has to be included in our financing plan. So the amount that we need to finance is 575,000 rands. We are issuing 1,000 debentures at 250 rands each. So from that we obtain 250,000 rands, which means what are we short? We are still short 325,000 rand. So that is what needs to be financed through the issue of new ordinary shares. So to obtain the 325,000 rands from the issue of ordinary shares, and the fact is we can issue them at 20 rands per share. How many shares do we need to issue? 325,000 rands divided by 20 rands per share means that we have to issue 16,250 ordinary shares. Then just not the whole journal again. The rest of the journal will still be the same as in example 1 and 2, just the financing of it. In this case, we are going to issue debentures to the value of 250,000 rands as we did before, but now the value of the ordinary shares that we are going to be issued is 325,000 rands, which means we are going to credit ordinary share capital with 325,000 rands, and the total amount that we deposit into our bank account through this financing is 575,000 rands. And then eventually, to conclude this whole redemption, we have to make the payment to our preference shareholders. So we're going to credit our bank account by 575,000, and then we no longer, once we've made the payment, we no longer owe the money to the preference shareholders, so we're going to debit the liability towards our preference shareholders, 575,000. Thank you very much. Now please go to the, or whenever it suits you, please go to the presentation that is without audio. There you can go through this step by step, slide by slide in your own time. Thank you.